This is one of the most powerful organizations in the world, influencing the decisions of some of the largest companies on the planet. Furthermore, that company holds a portfolio of assets valued at around $8 trillion, or much more than that. That's Vanguard, the asset manager that has conquered the market and directly influences technology companies in America, such as Google, Amazon, Microsoft, and many others. In this video, you'll learn how this financial giant was formed and who is behind such an enormous business. To give you an idea, with $8 trillion under its command, Vanguard owns about 7.8% of Apple, 8.46% of Microsoft, 7.91% of voting shares in the Alphabet Holding, owner of Google, and 6.89% of Amazon. Larger stakes even compared to its main rival, BlackRock. In addition to these holdings, it also has 8.7% of ExxonMobil, the leading U.S. oil company, and 7.07% of Tesla's shares. And these are just some of the companies it's related to. All of this is done with great discretion, making the full extent of its investments little known, and also with its financiers being unknown, giving many the feeling that the company is a kind of disguise for some of the most powerful people in the world. This has given rise to theories that the business could belong to some of the wealthiest families on the planet, such as the Rothschild family. However, what is known is that it all began with the vision of the investor John Bogle. Born on May 8, 1929, the future magnate was born into a wealthy family, but they lost that status a few months later during the onset of the 1929 crisis, causing his father's fortune to nearly vanish. His father spent what little remained on alcohol while lamenting the loss. The downfall of his father taught Bogle that it was necessary to pursue his goals and not expect anything for free. This is how, from an early age, he began to work and develop the habit of living with only what was necessary, saving as much as he could. In addition to working, he was also a brilliant student, to the point of earning a full scholarship to study economics at Princeton University. There, he learned how the dynamics of the financial market worked and saw a great opportunity in 1951 when he identified a kind of industry that would conquer the world of finance: mutual funds. At that time, the sector had around $2 billion in assets, a significant number but irrelevant compared to the overall figures of the capital market. Nevertheless, mutual funds operated as a collective effort where ordinary people entrusted their savings to a financial manager responsible for capital management, understanding which were the best assets to buy. At the time, mutual funds were viewed with great suspicion since Americans were still recovering from the effects of the 1929 crisis and preferred to keep their savings in bank accounts. Still, Bogle understood that investing in stocks through mutual funds would be a trend in the following years, especially as the American economy improved, and Americans had a greater appetite for investments. Furthermore, if managed by a fund with a long-term perspective, Americans' investments could provide them with extremely significant returns through a diversified investment mentality in the stocks of the country's leading companies, capable of weathering crises and instabilities in specific sectors. Bogle's vision turned into an academic work, earning not only honors for the student but also an invitation to join the administration of the Wellington Fund, a mutual fund based in Malvern, Pennsylvania. At the time, the fund was managed by Walter Morgan, who commanded around $150 million in assets, making the fund the fifth largest in the country in its category. Morgan was a former trader who, after losing almost all of his money, adopted a defensive strategy to protect his wealth. When he opened the fund, he aimed to attract individuals with a similar mindset, earning money slowly but steadily, without being dazzled by speculative opportunities and quick gains. Despite this, the Wellington Fund invested in various financial instruments, not just stocks, to mitigate market risk and volatility. This clashed with John Bogle's belief that the stock market held more long-term opportunities than other investments. Nevertheless, over the next 7 years, mutual funds grew tremendously in the U.S., especially because the American economy was booming, nearly doubling its indicators during that period. However, as Bogle had predicted, as the economy improved, the risk appetite of ordinary people increased. Consequently, the balanced and defensive portfolio of the Wellington Fund no longer attracted the same number of individual investors. Because of this, Bogle, who had become a shareholder in the business, decided to take the risk of going against his mentor's vision and created a fund within the company that exclusively held stocks, the Wellington Equity Fund. Despite his mentor's skepticism, the fund was a huge success, with assets under management of about $44 million in the first year alone, providing a return of around 30% for the initial investors. The success continued in the following years, maintaining a balanced philosophy of long-term stock investment. This success led Bogle, at the age of 35, to be appointed as CEO and successor to Walter Morgan when the mentor retired, making the Wellington Equity Fund the main focus of the company. However, as Bogle's personal success grew, he began facing criticism, and his fund lost appeal and clients to other more aggressive funds in the market thriving in a time of prosperity. This quickly put the future of the fund in doubt. In 1965, with no other option, Bogle had to explore the merger of the company with other funds of similar size in the market. However, no fund of similar size was willing to join Wellington, especially because Bogle's long-term philosophy differed from market practices. The only alternative was a merger with a smaller fund called Unveiled, which, to integrate its assets, took 40% of the business. Over the next 8 years, the merger was successful, giving rise to 10 other funds that, by 1973, had a total of $3 billion, in the values of that time, under the company's custody. However, everything looks good when the bull is loose, but when the market tide turned after the oil shock, the American economy began to face serious difficulties, and the company's portfolio shrank from $3 to $1.3 billion. This situation put Bogle at odds with the former owners of Unveiled and led to his dismissal from the CEO position. He was appointed as president of the company, a practically figurative role where he could not make any decisions about the investments of the mutual fund he had created. Thus, in 1974, John Bogle was defeated and humiliated. However, he found a way to turn the table. According to the rules, he couldn't make investment decisions, but as president, he could make decisions involving the business management. And so, he decided to innovate in the market. Until then, mutual funds only pooled money and had to outsource financial management to an investment manager. The Wellington structure encompassed both the fund and the management company, but by law, they couldn't be mixed. However, Bogle found a way to eliminate this intermediation and conduct the entire financial operation through a single structure, saving millions of dollars in the process. To change the course of the business, he decided to change the game and even the company's name, which became Vanguard. In addition, he launched the world's first index fund, now known as Vanguard 500, which holds shares of the 500 largest companies traded on the American market, according to the S&P 500 index. The idea for the fund came from an academic work by the award-winning economist Paul Samuelson, who in 2005 classified Bogle's endeavor as an invention as important as the wheel, the alphabet, and Gutenberg's press. Unlike a mutual fund, the index fund does not require active management, and due to its simplicity, its operating costs are much lower. Because of this, it was possible to invest small amounts in the fund, attracting all kinds of investors with a very streamlined operation. The simplicity was so significant that when it entered the market, the fund was ridiculed. However, by 1982, it already accumulated $100 million in assets, and by 1988, it was over $1 billion. The success was so great that from the 1990s, other financial market giants began to copy much of Bogle's strategy. After an absolute success, Bogle retired in 1995, passing the baton to Jack Brennan. Brennan was chosen by Bogle himself to succeed him but began to heavily invest in sales and marketing to attract an even larger number of investors, attracting a series of middle-class Americans. A strategy that went against Bogle's wishes, as he believed that extensive advertising could give the impression to ordinary people that the company was promising easy and immediate results, which clashed with his philosophy. Such a strong disagreement led Bogle to attempt to return to the company's leadership, but the board chose to keep him out of the day-to-day business. Without its founder, Vanguard took an even greater step when it fully entered another market that gained prominence in the late 1990s, the ETF, exchange-traded fund, market. ETFs are funds traded on stock exchanges, expanding Vanguard's reach infinitely. This move was also against Bogle's ideas, as he believed that the volatility of the instrument could be detrimental to investors. Nevertheless, the company continued down this path, and in 2020, one of Vanguard's funds, the Vanguard Total Stock Market Index ETF, became the first in the world to accumulate over $1 trillion in assets. Unfortunately, a year earlier, John Bogle passed away at the age of 89. Despite not agreeing with the direction of his company, he saw the business he created become an asset manager with trillions of dollars under its command. In addition to being the father of Vanguard, the investor also published his investment philosophy in the best-selling book The Little Book of Common Sense Investing. Without him, the company is expanding its reach more and more, both in terms of clients and market presence. Currently, Tim Buckley is the third successor since Bogle's departure, and he is the current head of the business, which, in addition to dominating the American market, has local operations in England, Australia, and China, and even works with government money. In 2020, Vanguard returned about $21 billion in managed assets to government clients in China due to concerns about legal compliance. The company also has funds operating in the pension sector in the US and Australia. With so much money under its command, there are doubts about where its influence begins and ends, and even about the extent of its power. How far do you think Vanguard's power extends? Share your opinion with us.